Well, thank you very much to Magnus and to the Thule Foundation for this very generous award and the invitation to talk about mortgages around the world, observations and lessons for policy. I'm not sure if I have insights, but I have observations. To set the stage, which has already been done to some degree, why are mortgages important? Well, they're the largest household liability in most developed countries. So if you're interested in debt, mortgages, that's the biggest component of debt. Let me actually just jump forward and show you a table on that. This is a table from a lecture I gave on household finance and regulation to the American Economic Association in 2016. And so this is a table looking at the household balance sheets around the world, averaging across households in each country. Unfortunately, I do not have data from Sweden. A lot of the good data in Europe comes from the Eurozone. So that makes it harder for me to include Sweden in this case. But the row that I've highlighted with a red box is reporting the percentage share in all the liabilities of a household that is due to mortgages. So for each household, we add up all their liabilities, we compute the percentage shares, and then we average across households. So in the US, it's just over half for a typical household is a mortgage. Same thing in the UK, similar in Spain. The Netherlands is pretty extreme, there it's 60%. It's a bit lower in some other parts of Europe, in Germany, for example, where home ownership is less common, and in France and Italy. But when you compare it with other types of debt, mortgages are really big. So that's one reason to think about mortgages. But there are also macroeconomic and monetary policy reasons, because mortgage rates are the main direct channel through which monetary policy affects household consumption. The household budget is going to be influenced when the interest rate changes and hence the mortgage rate changes. As I understand it, the Swedish central bank has just cut the policy rate by 50 basis points, and that may flow through to mortgage rates, and that will affect every household in Sweden with a mortgage. Of course, mortgage rates also have a strong impact on house prices and construction, so that's going to be another channel. And we know that there are financial stability concerns. Problems with mortgage lending were very important here in Sweden 30 years ago, and more recently in the global financial crisis. And even, no longer this spring, but last spring in 2023, the US regional bank crisis was driven by mortgage investments held by banks. So there's lots of reasons to care about mortgages. Now, if you look around the world, you are very struck by how diverse these systems are internationally. And people in every country tend to take for granted the structure of mortgages in their own country and are very puzzled and surprised when they learn about the weird things that other people do. So in Sweden, fairly short fixation periods are common. That came out in the Mentimeter poll that we just did. The same is true in the UK. But if you go to Canada, it's typical to have a 5-year fixed rate. And if you go to the US or your neighbor Denmark, 30-year fixation periods are common. So tremendous variation. Also, the rules governing refinancing vary a lot. So suppose you've got a mortgage with some fixation period and you want to refinance, perhaps because interest rates have changed. How do you do that? Well, in the US, you have to pay off the face value of the debt. In Germany, you have to pay off the market value of the debt. In Denmark, you get to pay off the lesser of the two. And as I understand it, in Sweden, you have to pay off the greater of the two. So every possibility exists. And we should think about what these different rules do. Now, there are, of course, also Regulations about LTV, sometimes debt to income or mortgage payments to income, and then amortization requirements. And those also came up in the poll, the Mentimeter poll that we were just doing. So most countries do have some form of regulation, and banks, of course, will restrict how much they'll lend. One important question is whether these limits apply if all you're doing is refinancing your mortgage to lower the rate. So in the US, if you take out a mortgage, fixed rate mortgage, and your house price falls, so now you're above the LTV limit, you may not be able to refinance to lower your rate. In Denmark, on the other hand, you have an absolute right to do that. After all, you're lowering the credit risk, if anything, by lowering your rate, and you're not borrowing anymore. So anyway, there's a difference between those two systems. And then what are the requirements for amortization after origination? Is it possible to take out an interest-only, zero amortization loan? Clearly it is in Sweden, according to the Mentimeter poll. We know that. And then a question would be, is negative amortization ever allowed? Are you ever allowed to pay less than the interest on the debt so that the principal balance is accumulating? Another question would be, what happens when you want to move? In the US, you must pay off the mortgage. In Denmark, it's quite common for the mortgage to be assumable. That means whoever buys the house from you will take the mortgage over. And if the mortgage has a very attractive low rate, they might pay you more for the privilege. So you'll be able then to use that to finance your new home. Alternatively, the mortgage might be portable. That means that when you buy a new house, you take your mortgage with you. And that's quite common in Canada and the UK. Now, finally, we should think about the funding of mortgages. So where does the money come from that is being lent in mortgages? Now, one possibility is deposits at banks and other depository institutions. And that's particularly common in countries with adjustable rate mortgages, because then the deposits have an adjustable rate, the mortgages have an adjustable rate, it's matched, you don't have maturity mismatch. The countries that have very long-term fixed mortgages tend to have some other system of funding, which might be covered bonds. As I understand it, those are used here in Sweden, but with shorter maturities, something like 5 years. In Denmark, to fund the 30-year fixed-rate mortgages, they have 30-year covered bonds. And in the US, we have mortgage-backed securities, which play a similar role. Finally, I should just mention that beyond these broad features I've been talking about so far, there are also sort of unique things that come up in certain countries. So in the US, there's a system called points, which is a system that allows you to borrow a little extra money above and beyond the face value of the mortgage, supposedly to cover your closing costs. But just think of it as borrowing a little extra money. In exchange for the little extra money, you don't change the official debt, you just change the interest rate. Now, when you think about that, that is very, very weird. That is not textbook finance. Textbook finance says there's an interest rate. You pay the interest rate. If you want to borrow more money, the debt goes up. But points messes with that. I'll come back to points later. And then, of course, some countries that have had experience with very volatile inflation have inflation indexation features. That's important, for example, in Israel. Okay, so what do I want to talk about? I'm going to jump around. This talk is a bit of a hodgepodge. It draws on some of my research, other people's research. But I'd just like to touch on some of the issues. And in each case, I'll try to use this international diversity as a way to understand the alternatives. So number one, let's think about the fixation period and monetary policy. Then I want to talk about the possibility of a lock-in effect when interest rates go up. This was another Mentimeter question that seemed to be relevant. Then I want to talk about options that people have to, for example, choose when to refinance. And my theme here will be that people love options, but they mess them up. So the mismanagement of options, I think, is a real problem in financial markets generally, and particularly in mortgage markets. Then I want to talk about some research that I'm doing using Danish data on trying to study consumer preferences over the fixation period, who likes which kinds of mortgages. And then finally, a few remarks on amortization and the life cycle, which is a big topic in Sweden, and I understand that the committee chaired by Peter Englund has just reported and has some suggestions for relaxing amortization regulation in Sweden. So I'll finish with that. Okay, so starting with fixation period, amortization, and monetary policy. I want to talk a little bit about the mortgage channel of monetary transmission. What is this? It is the way in which monetary policy affects the economy by changing mortgage rates, changing mortgage payments, and therefore changing consumer spending. Right? Now, this channel is not about intertemporal substitution, which is the classic new Keynesian models that write down the Taylor rule and how that affects the economy. That's all about intertemporal substitution, that when the interest rate goes up, people want to save more. This mortgage channel is about redistribution across agents. And recent paper by Adrian Auclair in the American Economic Review sort of makes that point really clearly. So how can we get an effect? The mortgage rate affects the monthly payments by borrowers, but it also affects the payments received by lenders. So the only way you're going to get an aggregate effect is if borrowers change their spending more than lenders do. Why might that be? One story would be, well, the borrowers are domestic residents. If the lenders are foreigners, they're spending on foreign goods, so we can affect aggregate demand domestically by changing the mortgage rate. The other argument, which is more important in the literature and more important in most countries, is that borrowers have a high marginal propensity to consume. Why? Because they're borrowing constrained. They're borrowers. That's why they took out a mortgage. While lenders are, rich individuals or institutions they have a much lower marginal propensity to consume. They are permanent income consumers. Now notice that the second argument only works if the mortgage payment change is temporary. If it's permanent, then the permanent income consumers will change their consumption one for one, just the way the borrowers do, and you won't get any aggregate effect. Now, what this means is that the mortgage channel is stronger for a short fixation period. If you have adjustable rate mortgages primarily, as you do in Sweden, then the interest rate is going to be it's going to have a stronger effect on the economy than in a country like Denmark, where you have long fixed periods. And there's three reasons for that. Number one, the adjustable rate mortgage payments, those are linked to the short rate normally. But fixed rate mortgage payments are linked to the long-term rate, which moves less because the central bank moves the short rate around. Typically, the long rate moves less. Secondly, the adjustable mortgage payments change for all borrowers. So every household in the economy with a mortgage is affected. But in a fixed mortgage system, the payments only change for new borrowers and refinancers on the downside. And refinancing may be limited, certainly it is in the US, by credit restrictions and then also borrower inertia. So that's another reason why you get a stronger channel with adjustable mortgages. And then finally, the change in adjustable mortgage payments is temporary because it's linked to the short rate, while any change in fixed mortgage payments is going to be more long-lasting. A refinancing changes the mortgage rate for a long time. So the lenders to fixed rate mortgages will adjust their consumption more, and that will have a stronger offsetting effect. So those are three reasons why, if you've got an adjustable mortgage system, the central banks changing the interest rate will hit consumption spending by more. Now, why do we care? You might not care. The central bank might not care about the strength of monetary transmission if it can just adjust the interest rate as much as is needed to move the economy. If the if you have a car that doesn't respond very much to your gas pedal, you just put your foot down more heavily and you still take the speed you want. But it might care, the counter-argument would be that the central bank may care about the relative impact of monetary policy on households and businesses. So the mortgage channel primarily affects households. So in Sweden, monetary policy is hitting households more relative to businesses than would be the case, say, next door in Denmark. Another reason to care would be if the central bank is implicitly or in some informal way pegging the exchange rate to a foreign currency, the euro maybe, whose interest rates are calibrated to a different mortgage system. Then there'll be an asymmetric effect if the mortgage system is different. And then finally, if you have a big country like the US where the adjustable mortgage share is higher in some parts of the country than others, then when the Fed moves the interest rate, it's actually hitting some regions harder than others or benefiting some regions more than others. Okay. Now, I've said, adjustable rate mortgages strengthen monetary policy transmission. You might ask, can you do even better than that? Is there a way to set up the mortgage system to really empower the central bank to stimulate the economy when it needs to? And in the COVID-19 pandemic, in many countries, and certainly in the US, there were ex post rule changes to allow mortgage forbearance, to essentially allow people to take a holiday on payments without penalty, essentially extending the maturity of the loan. Now that was done ex post, but you could do it ex ante, which would probably be better because it's not a good idea to mess with financial contracts after the fact. So I wrote a paper a couple of years ago with Nuno Clara and João Coco, where we studied the effect of creating a mortgage system in which you can go to zero amortization for everyone in a recession, and we use a structural model to study what that would do. And importantly, the model looks at the implications for default as well as consumption, because if you let people not amortize, then they're going to have more debt because they haven't paid it down, and then you may get more defaults if their income goes down. And if we think that mortgage defaults are bad for the economy, then we get foreclosures. We need to study that outcome as well as consumption. So I'll just show a figure or two from that paper before moving on. So the different colored bars correspond to different mortgage systems, and the blue bar at the far left is a baseline adjustable rate mortgage. The sort of red bar is a baseline fixed rate mortgage. For the moment, ignore the green bars at the right. Those are what happens if you start in a low interest rate environment. But the left figure here is showing the cyclicality of consumption growth, how much consumption growth accelerates in a boom as opposed to a recession. And to stabilize the economy, we want to reduce the cyclicality of consumption growth. So the blue bar is a little bit lower than the red, but the light blue bar does much better again. The light blue bar builds in this option to turn off amortization in a recession. The default rate is shown at the right, and it says cyclicality. It should really say counter-cyclicality. This is the extent to which defaults go up in recessions. That's highest for the red bar, which is fixed rate mortgages, a little lower for adjustable mortgages. Why? Because rates fall in recessions, and that reduces defaults. But notice that the light blue bar actually goes down as opposed to up. That says that with the option with the forbearance option in a recession, you actually get more defaults in a boom. Why is that? Well, that's because the boom is when you have to once again begin to amortize your mortgage. And so that can trigger defaults. But it's better to have defaults in a boom than a bust if you're interested in stabilizing the economy. Lenders do particularly dislike having defaults in recessions, so they're quite glad to have the defaults in the boom instead, and for that reason the loan premium actually is a little lower. The mortgage rate in equilibrium is a little bit lower for the forbearance option. That's shown in the left figure. And then the right figure is showing welfare gains relative to the plain vanilla adjustable rate mortgage, and you can see you get a big welfare gain in that light blue bar at the left, more so than the other systems we're talking about. Okay, so I don't want to get stuck on that in the interest of time. Let me move to the next topic, which is monetary tightening and the lock-in effect. So my discussion so far about the mortgage channel has been symmetrical. I've talked about easing and tightening pretty symmetrically. But there is another mechanism by which long fixation periods may specifically weaken the effects of a monetary tightening. So suppose you've had a spike in inflation, you want to raise interest rates, slow down the economy. That's what we've just been doing. Now, in a fixed rate mortgage system, it's disadvantageous to refinance when rates rise, at least under US rules it is. And then these fixed-rate mortgage borrowers become reluctant to move. They get locked in. And it would seem that that is relevant even here in Sweden, according to the Mentimeter poll. But it's particularly important in the US because of the very long fixation period. And if people are reluctant to move, then there's a decline in homes for sale, and many people think that can prop up house prices, which reduces the contractionary impact of higher interest rates. So this is a very active research area. Let me show you a figure from a paper by Fonseca and Liu, which has been around now for about a year. This is showing the micro-evidence of lock-in. Now, you might think it would be hard to prove lock-in, given that until just recently, mortgage rates had been falling for such a long period of time. So there weren't really big periods of rising rates to study. But the clever thing about Fonseca and Liu is they point out that the incentive to move depends on how much rates have declined since you took out your mortgage. Now, if rates decline a whole lot, say more than about 1.8%, then you should refinance without moving. You should pay the cost of refinancing. You should do that anyway, so all the mortgages should reset. But if rates go down by something less than 1.8%, it's not worth refinancing without moving, but if you move, you can get a new, cheaper mortgage, and that will lower the cost of moving, and that should stimulate moving. So the line here is showing the horizontal axis is what they call the rate delta, which is how much cheaper will it be to take out a new mortgage than the one you have. And the higher that thing is, the higher the moving rate, until you get to about 1.8%, because beyond that, the only people with these old expensive mortgages are people who don't know about refinancing and are just confused. And so you don't get any further effect. Now, lock-in is this is lock-in everywhere, but the region we're in now is to the left, where there's a cost. You're going to pay a higher rate if you move, and that forces you into a region that we haven't seen until recently. So why is everybody talking about this now? Well, here's what's happened to US mortgage rates. This is a plot from just data from Fed, the Federal Reserve Bank of St. Louis. You got a sharp increase in the 30-year fixed mortgage rate in 2022 and some further increase in 2023. That rate was below 3% in 2021, and it's almost 7% now. So that's a big, big rate increase. And yet, house prices, you might have thought this big increase in interest rates would drive down house prices, but it hasn't done that. This is the S&P Case-Shiller National Home Price Index. It's smooth, but you can see that since the pandemic recession is the gray bar, rates have just risen enormously by house prices have risen by about 60%, And there was only a very, very modest dip in 2022, 2023 when mortgage rates went up. So there's a big puzzle about that. You might think it's something to do with lock-in, that existing homeowners are reluctant to sell because they'd give up their old cheap mortgages. And this plot shows housing inventory, the count of new listings in the US, and that's very seasonal because people sell houses in the summer. So this is the year-on-year change, which gets rid of the seasonality. And you can see how that year-on-year change was very negative in 2022 and 2023. It's become positive again more recently in 2024, but still very modest. So the overall level of new listings is still down. Now, there's an obvious objection to the lock-in explanation for high house prices, which is that a seller is also a buyer. So if you remove sellers from the market, you're also removing buyers from the market. To get an aggregate effect, you've got to do something clever and cross-sectional. You've got to have a sector which has more elastic housing supply. For example, if sellers, they might be older people, maybe they're moving to the rental market or to senior communities or something like that where the supply is elastic, in which case the removal of the buyers doesn't do much to price, but the removal of the sellers does. Or alternatively, it could be regional. If sellers are in Boston, where it's very hard to build houses, but they're moving to Florida, where it's cheap to build houses, then you could get an aggregate effect because the market where people are not selling is one where just prices go up, and the market where buyers are removed is one where just quantities adjust. So this general equilibrium modeling of the lock-in effect on house prices is a currently active research area. I have a student, for example, PhD student, Justin Katz, who's working on a job market paper about this for next year. It's a very interesting research area. I haven't mentioned, because it doesn't apply so much in the US, but if a country tightens its amortization rules, then people with old mortgages that don't have to amortize may be reluctant to move because they don't want to have to start amortizing. And that's another kind of lock-in effect. According to the Mentimeter poll, that wasn't so relevant, but it could certainly be an issue here in Sweden. Okay, well, moving right along, and I know I'm jumping around here from topic to topic. Let's talk about options in mortgage management. And the theme here is people love them, but they mismanage them. So many financial products have built-in options, the contingent right to do something at your discretion when the price is favorable. This may explain why long fixation periods are popular in the US and Denmark relative to Sweden, because in the US, you're being given a valuable option. You can refinance when rates fall. You can pay back your mortgage at face value, and that's an option. And you might want to do that. People like that. Same thing in Denmark, although in Denmark there's no lock-in when rates rise, because actually households also have the option to refinance at market value in those circumstances. But in Sweden, under the refinancing rules, it's basically never favorable to the borrower, so it doesn't become one of these seductive options. Now, why do I say seductive? The reason is that people don't actually exercise these options optimally. They mess it up. And who is it that particularly messes up is people with less education, less income, less wealth. And this is a source of inequality in the financial system that I think we should be very concerned about. So I've done some work looking at Denmark where you can measure this effect of sophistication very cleanly, because in Denmark there's an absolute right to refinance from one fixed rate mortgage to another, lowering your rate. And it doesn't matter what your credit score is, it doesn't matter what your house price is. All of those things don't change your ability to do this refinancing. And then you can also borrow the refinancing cost, so you don't even need to have ready cash to do it. So let me just show you a plot from my paper in the AER in 2020 looking at this. This is a figure that shows what we call refinancing efficiency. What does that mean? Well, in the period we studied in Denmark, rates were falling, so you could save money by refinancing. What we do is we calculate how much money would you have saved if you had refinanced following an optimal strategy in an academic paper by my colleague David Leibson and co-authors. So that's the benchmark, is do what David Leibson tells you to do. And in fact, people don't do that. They refinance more slowly. And so the refinancing efficiency is less than 1. People save some money, but less money than they would have saved if they knew what to do. And then we measure this for every Danish mortgage borrower, and then we sort them into quintiles by age, education, income, financial wealth, and housing wealth. And the line here with X's is the effective age. So there's a little bit of a hump shape, but you can see older people do less well. Then the other lines mostly slope up, and those are the lines related to education, income, and different types of wealth. So basically, the richest people are saving about 3/4 of the money they would have saved if they'd done things optimally, and the poorest people are saving only about half the money that they could have saved. So there's a big discrepancy there. Now, I should say, although that's a study of Danish data, the same thing happens in the US. So, for example, there's a study of so-called pre-qualified refinancing offers where the bank writes to the borrower saying, would you like to save money by refinancing your mortgage? We've already approved you. People don't respond. Same thing happens. And a particularly troubling fact is that this slow refinancing helps to explain racial discrepancies in the mortgage rates that different borrowers pay. So there's a study by Girardi, Willen, and Zhang from the JFE last year which points this out. So let me show you a figure from that paper. The colored lines at the top here show the gap between the rate that black borrowers are paying and the rate that white borrowers are paying. The red line is the gap for new loans. And that gap is small and can be explained by other borrower characteristics. So there's a lot of regulation of racial discrimination in mortgage lending in the US, and it's pretty effective. There's a modest gap in the rate, and that gap is explicable by non-racial factors. The problem is the blue line. The blue line is the gap between the rates that borrowers are actually paying on the stock of outstanding mortgages at each point in time. And that rate gap rises when interest rates fall. The black dashed line at the bottom here is the level of the interest rate. When that rate falls, people have an incentive to refinance. White borrowers refinance, black borrowers don't. Black borrowers end up paying a lot more. And that's what that blue line shows. And that blue line gets up to 60 basis points at the peak. Okay, so this gap in sophistication really has big effects on the mortgage rates that people pay. And what this leads to is a cross-subsidy from the poor to the rich. This is a reverse Robin Hood transfer from the poor to the rich. Why? Because in a competitive market, the extra revenue that mortgage lenders get from people who don't refinance is partly passed on in the form of lower upfront mortgage rates. So sophisticated people who know how to refinance benefit. They get a cross-subsidy. They're pooling with the non-refinancers. And this is an example of the equilibrium that's sometimes called shrouded equilibrium, described by my colleagues Xavier Gabex and David Leibson in a theoretical paper in 2006. It's even worse in the US because of this system of points, which I mentioned, because if you take points, you borrow a little extra money to cover your closing costs, you raise the interest rate. You then have a really strong incentive to refinance, but lots of people don't do it. The cross-subsidy also makes it harder for innovators to introduce new mortgages that might be easier to manage. Think about designing an automatically refinancing mortgage that just adjusts the rate in a kind of ratchet system whenever the rate falls, but doesn't allow it to rise. That could be great. That would reduce transactions costs. But the people who really benefit are the unsophisticated people. Sophisticated people wouldn't like this product because if they took it, they would lose the benefit of the cross-subsidy from the unsophisticated. So it's kind of a catch-22 for people who are trying to sell these things. The people who will benefit are really hard to reach, and even if you educate them, now they're sophisticated, they might use their new knowledge to say, no, I'm going to stick with the existing product and benefit from all the other poor saps who don't know how to refinance. So there are many problems with this kind of cross-subsidy, and by the way, this is a general problem in personal finance. Now, I'm running out of time, and I need to avoid going on too long. Let me just, but finishing on options, it's not just a problem with fixed-rate mortgages. In the US and Denmark, those are the mortgages that require refinancing and generate inequality, but you can have similar problems in adjustable mortgage systems too. So many countries with adjustable mortgages have so-called teaser rates in the first year that then jump up after a year or so to a much higher rate that's sometimes called the standard rate. And sophisticated people know that you always refinance at the end of the teaser period, and that leaves less sophisticated people to pay the standard rate. And that problem was pointed out in the UK 20 years ago by David Miles, or a commission chaired by David Miles, but it's an ongoing issue in the UK. Okay, I think that I will summarize very briefly what I wanted to say about consumer preferences over the fixation period. Yeah. 10 minutes, all right. I've got 2 more topics and we'll do 5 on each, okay? All right, so what do people actually want? I've talked about these mortgage systems from a point of view of, a grand regulator, a social planner, a central banker who just decides. But borrowers want things. What do they want? If people are given a choice of fixation period, what do they do? Now, in the time series, it's not surprising that they tend to pick mortgages that are cheap. The spread between different types of mortgage rates is relevant, and recent movements in mortgage rates are relevant. So in US data, adjustable mortgages are normally cheaper when you originate them, and the market share of adjustables, which is the bars in this figure, it tends to go up when the spread is wide, the gap between those 2 interest rate lines. And also it tends to go up when mortgage rates have been rising because that influences what rates people expect in the future. But in the US, the arm share is always low. It's varying between, say, 10 and 20%. But what about the cross-section? So which types of households do what? Now, in the US cross-section, the arm share is higher for subprime mortgages with low credit quality borrowers and jumbo mortgages, which is big houses, big expensive houses, and lower for so-called conforming mortgages of borrowers of decent credit quality that aren't too large. People often say in the US this is because there's an implicit government subsidy to fixed rate conforming mortgages. So it's some sort of distortion in the mortgage market caused by government intervention. The interesting thing is, in some research I'm doing now on Danish data, we see similar patterns there, but there are no government subsidies distorting choice in Denmark, so there must be another explanation. So I'm going to skip the details of this study and just tell you the result. We find that the arm share is higher in 2 separate groups, the young borrowers who are first-time home buyers with low financial assets, and then middle-aged borrowers with large houses and high financial assets. And we think what's going on is that adjustables are appealing differently to these 2 groups. The first group is borrowing constrained. They just want a lower current rate. By the time rates go up, if they do, these people expect to have higher income, so that'll be fine. That's the future. The second group, on the other hand, is using ARMs as a cheap way to lever a financial portfolio. And if rates go up in the future, they can always just delever and pay off the mortgage. It's just a way to avoid selling your portfolio of stocks and bonds to buy your house. Instead, you borrow very cheaply with an ARM, you keep your portfolio of stocks and bonds, and in effect, you're moving out the security market line in the textbook diagram. So, we've got a lot of stylized facts, and what we're currently doing in this project, I'm going to skip forward for time, but what we're currently doing in the project is setting up, solving, and simulating a life cycle model of mortgage choice with risky income, random interest rates, refinancing costs, and so forth. And the goal is to show within the model that we can replicate this pattern that we see in the data of the two different kinds of groups who like adjustables. One caveat I should mention, though, is that in the data, these observable fundamentals, while they go in this direction, they actually have low explanatory power. There is a lot of unexplained variation in mortgage choice. And when you study household finance, this comes up again and again. It's very hard to explain at the individual level what people do. So clearly beliefs or peer influences, family influences, those things are also very important. Now, just to finish, because it's such a topical issue in Sweden, let me talk about amortization and amortization over the life cycle. Consumers versus regulators. Many consumers find it appealing to lower mortgage amortization, keep it low with a long maturity mortgage, or set it to zero with an interest-only mortgage, or even have negative amortization. You can take out a second mortgage, or in the US, a home equity line of credit, or if you're an older person, you can use a reverse mortgage. That is extracting home equity, borrowing money and getting it out of the value of your home. And then regulators often worry about this because of the risks. Maybe people are not going to save adequately for retirement. They're treating their house as an ATM. If income falls, borrowers will become financially distressed. And if house prices fall, you'll get defaults, foreclosures, and perhaps financial instability. So this is, of course, a big topic in Sweden. And there's just a proposed relaxation of some amortization regulations that were put in place in Sweden after the global financial crisis. So a few points about this. I think one point I'd make is you really want to distinguish nominal versus real amortization. So the downside risks have to do with the real burden of debt on households. And I would say there's nothing wrong with negative nominal amortization that's less than the inflation rate, because that's going to be still positive real amortization. I also think, related to this, that adjustable mortgage design can be improved by, instead of just increasing the interest rate and thus the required mortgage payment when inflation goes up, you adjust the nominal principal upward, but you smooth the real payments over time. So I think there's really room for design improvements that keep the best parts of adjustable rate mortgages while smoothing the payment risk, which can be a big problem. Of course, if you're an unconstrained borrower, you can effectively do the same thing on your own by discussing it with your bank, but people who've hit a borrowing limit cannot do that. Second point I'd make is about the life cycle. I think amortization policy should be sensitive to the stages of the life cycle. Young households at the beginning of their careers expect rising income, and the standard model says they should not save aggressively. So for them, I think IO mortgages are appropriate. Middle-aged households are in their peak earnings years and should save for retirement. And if they're not doing it voluntarily, and if other aspects of the retirement system are not sufficient, mortgage amortization requirements can help. But older households may be house rich, cash poor. They may be wanting to run down their assets while still living in a house. And for them, IO or even reverse mortgages or related measures like property tax deferrals may well be suitable. When we look in Denmark, by the way, we do see actually that IO mortgages appeal particularly to the young and the old. So young households in Denmark like IO fixed rate mortgages. Middle-aged households choose amortizing mortgages. Those are the dark blue bars. And then older households choose ARMs in Denmark, and those are almost all IO. So we do see the theoretically appropriate age hump shape in amortization within the Danish system. That's being chosen by people voluntarily. And I think regulators should keep that in mind. So my last thought on mortgage policy is we should not assume that the mortgages we have are the best that can be designed. At a minimum, we should look around the world and see what else might be feasible. But I also think that policy should make space for innovations. So I've mentioned a few things along the way. Automatic refinancing. I think, in an era where engineers are designing self-driving cars, why can't we make self-driving mortgages? Inflation indexation of mortgage balances so that you allow negative amortization in nominal terms, but not in real terms. That's maybe not relevant when inflation is dead, but inflation seems to have come to life again. Negative amortization for retired people who are house rich but cash poor and don't want to move. Reverse mortgages, IO mortgages. They exist in Sweden, they exist in the US. They're expensive in part because they're not standardized and are poorly understood, so the companies that sell them have high marketing costs. But I think there's room for innovation there. And then finally, the possibility of indexing principal to home values, so-called shared appreciation mortgages. Those are starting to be offered by fintech companies in the US, and I think it's an interesting trend to watch. So I think, regulators should allow these sorts of innovations to be tried out. It's sometimes called a regulatory sandbox, where you let these things can be played with in a sandbox. Of course, once they start to take off, then you do need to think what regulations are appropriate. But it's very important not to choke off innovation, because I don't think we have yet discovered the best possible products. So I will stop there. Thank you very much. Happy to take questions.